If you asked me a year ago how I thought 2025 would play out, calling it the worst year of real estate in 30 years wouldn't have even crossed my mind. I believed 2025 would be the year where pent up demand finally met significantly lower interest rates, creating a very busy and active market in favor of the sellers. And at the start of the year, that didn't feel unrealistic. I had a lot of conversations with people planning moves, buyers were warming up, momentum felt like it was coming back. I finished 2024 as a career year and expected 2025 to build on that momentum. Then, late January hit. Trump came into office, trade war threats escalated, and uncertainty spread quickly. Confidence evaporated almost overnight, and for the first time in my career, having a listing no longer meant there was a high probability it would sell. That shift was jarring, and it wasn't just me. Agents across Canada experienced the exact same thing. Now, at the end of 2025, Toronto real estate is in an ugly place. We have low optimism, low confidence, and we're firmly in a buyer's market. Buyers regain leverage on both price and terms, and every single deal has to be handled with white gloves because there is a risk of the deal collapsing. In past downturns, sellers could at least wait for something. More rate cuts, fewer listings, stronger demand. But today, the rate cutting cycle looks mostly finished. Population growth is slowing and in some cases reversing, and the economy and job market are facing very real headwinds. So heading into 2026, there are a lot of moving parts and very little certainty. I'm not convinced prices will rebound meaningfully in the short term, but regardless of whether prices go down, move sideways, or even slightly rise, I do think 2026 will be an active market. Buyers are coming back, especially first-time buyers who've been waiting on the sidelines, and sellers. Many will test the market to see where values really land. But my overall view is simple. Supply is likely going to outpace demand, and that will keep the advantage with buyers. So in this video, I want to walk through the biggest factors that will impact the 2026 market, how buyers are actually perceiving value right now, and practical advice for buyers and sellers heading into 2026. So let's get into it. The number one elephant in the room are mortgage renewals. In 2026, we're looking at roughly $400 billion in mortgage renewals across Canada. A large portion of these mortgages were for homes purchased near the 2021 peak at much higher prices and are now renewing at interest rates more than double what they had before. For some homeowners, that payment shock is going to be severe. Add to that people who refinanced at peak valuations, reverse mortgages taken out when prices were higher rates combined with lower home values, and for many households, equity is disappearing faster than expected. Some homeowners simply won't be able to carry their homes anymore. Some will sell voluntarily, some will default and sell through power of sale, which we're already seeing increases across the country, and others will be forced to ask a hard, uncomfortable question. Is this home still working for our life, or are we working for the house? Which leads directly to watch out number 2, the slow death of work from home. Across the Greater Toronto Area, companies are steadily pulling people back into the office. 2 or 3 days in office is turning into 4 or 5. That matters, especially for people who left Toronto for larger homes in the 905 or beyond. A 3 or 4 hour daily commute looks very different once it becomes permanent. Over time, the trade-off stops making sense. Just like we saw the flight out of Toronto during the pandemic, I think we may see some migration back into the 416. That said, affordability will limit how many people can actually make that move. Lower prices help, but not everyone will qualify. Still, I expect the 416 to hold up better than much of the 905 as these shifts play out. My third watch-out is market fatigue. For decades, Canadians believed one thing almost universally: real estate prices always goes up. But now we're entering year 5 of declining sales and falling prices, and that belief is deteriorating. The result is that trust in real estate as an asset is disappearing. Many sellers were waiting for lower rates to bring back the glory days, but if that was going to happen, it should have happened in 2025. Instead, we now have lower interest rates, lower prices, and an outlook that feels increasingly uncertain. That creates seller fatigue. Some sellers will simply decide to sell before things get worse. Others will accept that the most motivated sellers are now setting market value. How much lower can sellers wait? For many, The answer may be not much longer. My fourth watchout is the rental market wildcard. The rental market doesn't get enough attention in these conversations. Toronto has a massive amount of rental supply coming online. At the same time, population growth is slowing and in some cases even declining. Some apartment buildings are offering 2 or even 3 months of free rent on a 1-year lease just to fill units. As rents soften, more would-be buyers may decide to rent longer instead of buying, which quietly pulls demand out of the resale market. This doesn't crash prices overnight, but it absolutely affects momentum. My watchout number 5 is oversupply in the higher price brackets. Demand will drop as prices rise. Like, you simply don't have the same buyer pool at $2 million as you do at $1 million, and the data shows it. In late 2025, across Toronto, over 50% of freehold house listings between $800,000 and $1.2 million sold, but only 35% of listings between $1.8 million to $2.2 million sold. As more downsizers try to sell larger homes, that imbalance could grow. Understanding where your home fits or where your budget fits has never been more important. And watchout number 6, investors are largely gone. Short-term speculation in real estate has been gone since 2022. Most buyers today are end users or semi-investors buying with future personal use in mind. With falling rents, reduced immigration, higher taxes and ownership costs, it's a near impossibility to cash flow even neutrally as an investor. This impacts the condo market, but also hurts investor-heavy markets like Milton, Brampton, Oshawa, Hamilton, Kitchener, and Waterloo. But for first-time buyers willing to house hack, manage tenants, and accept longer commutes, this environment can create real opportunity. Old comps don't matter the way they used to. Sales from 6 or 12 months ago are often yesterday's news, transactions that occurred in a different market. Value today is set by very recent sales, typically the last 30 to 90 days, and what else is actively available in that neighborhood right now. Buyers operate within very clear price brackets: $1 million, $1.2 million, $1.3 million, $1.5 million, $1.7 or $1.8 million, and $2 million. And of course, as you graduate higher and higher up the scale, you also get different qualifying homes by neighborhood. Each step up needs to feel worth it. Sellers often believe their home belongs in a higher bracket when the market is clearly telling a different story. And features that once commanded huge premiums, renovations, ravine lots, oversized lots, are now being discounted by buyers. A 10 to 20% premium in past markets might only feel like 5 to 10% today. And that is a very difficult pill to swallow for sellers. Value isn't linear. It's emotional, comparative, and very subjective. Here's my advice for buyers. Be open to homes that need a bit of work. The prettiest homes will always get the most interest, so don't fall into a trap by paying more money when there are many options out there. Remember, there will probably still be a lot of buyers, so you may run into competition on nice homes, but overall supply should outpace demand. So don't let a paint job scare you away from homes that are well maintained and in great neighborhoods. Be open to negotiating on price and terms, and be open to looking at homes that appear above your budget with the potential to negotiate down. Now, here's my advice for sellers. Don't be too married to your price. And if you have a legitimate agenda and timeline to sell, don't let pride in your home prevent you from accomplishing your goal of selling. A neighbor with an inferior property could have sold for a higher price 1 to 2 years ago, but that was the past and does not reflect today's market conditions. Be willing to work with every buyer, and remember that every time you make a counteroffer, it's as much an opportunity to negotiate for a better price and terms for you as it is for the buyer to reevaluate whether your home works for them and walk away from a deal. Also, keep in mind that value is not linear, and while in the past your home might have been able to graduate to the next bracket of price ranges, that may not be the case today. As a seller, it can be hard to release your expectations from what your property features should be yielding, but you cannot control the market perceptions, and it's your decision whether you operate within the current sandbox of the market. So that's it for me. If it's your first time seeing me, my name is Jonathan Lee. I'm a Toronto area realtor based out of Etobicoke. If you're looking for help navigating this crazy real estate market, or you just have some questions on what's going on out there, you can schedule a call with me using the calendar link below. Thanks for watching, and I'll see you guys on the next video. Cheers.